In this video, I'm going to cover a few principles that I've found over my career to be the most helpful and impactful principles that if people follow and really understand are going to put them in a far better and stronger financial position once they retire, whether it's at age 60, 55, or sometime later on in life. Don't forget to watch all the way to the end, where I'll also cover some of the common mistakes that I see people fall into or fall victim to. And so if you can avoid these, all the more so you're going to be in a better position to retire strong and with a lot of confidence. So without any further ado, let's get right into it. So we're coming up on the 4th of July weekend, and I wanted to put together kind of a simple, fun, short video, shorter than what I normally do, covering what I find are some of the most important principles to help anybody retire successfully. Now, if you're watching this video and you're getting close to retirement, it's going to be relevant for you. If you're a little bit younger or even in retirement, I mean, to be totally candid, these are principles that really stand the test of time, whatever kind of period you are at. I'm going to be talking about this mostly from the perspective of somebody who's maybe, a little bit, on the younger side, maybe in their 40s or 50s, getting ready for retirement in the upcoming decade. And like I said in the introduction, I also want to talk about some of the things that I see as a financial advisor. I meet a lot of people from across the country, and you see kind of common patterns that people, just common patterns from all walks of life, where people make financial mistakes or they do something and they kind of regret it afterwards. And so I want to talk about some of those key situations and issues that I see that get people into trouble. So first, let's talk about some of these very simple fundamental principles for successful preparation for retirement. The first thing I want to talk about is, and this is all going to be around investing, frankly, is staying in the market. I remember in my first financial planning course in college, I'm sitting there, I didn't know anything. I didn't grow up, in a family with a lot of money or anything. In fact, we were dirt poor. But anyway, I'm sitting in this investment class, and we're looking at this investment chart of the S&P 500 over time. And my professor, his name is Jacob Zabrowski over at Utah Valley University.
Even if it's a boring lecture, but stay focused and be attentive. That's part of professionalism.
He shows this chart, and you see it going up, and then you see it going down with the financial crisis. And he goes, now what if you could have invested right here, and then got out and invested right here, and got out and invested right here. Essentially what he was trying to illustrate was how great would it be if you could have invested and missed all the downsides and only invested just at the right time to kind of participate in the upswing of the market and then get out before the market dropped again. And I'm sitting there thinking, wow, that is genius. You're right. Everybody should do that. And then his whole point of pointing out that kind of very simplistic, obvious approach or whatever was to then go on to clarify and teach the principle of how difficult it is to try and time the market. And so I'm going to show a little bit of data looking at the stock market going back to the early 1900s all the way up to the present to kind of understand more about this idea. Okay, so on the screen in front of us, we're looking at an analysis done by Capital Group. They're an investment firm based out of Southern California. And we are looking at how often the S&P 500, which is a market index that tracks the 500 largest publicly traded corporations in the United States, we're looking at how often the returns of that index have been positive or negative. We're also looking at that positive or negative return profile over different time frames. So over 1 year periods of time, or 3, or 5, or 10-year periods of time, how often have those returns been negative or positive? So first thing on the screen, you'll notice here in this top right here, this one right here. So over that period of time, over any given 1 year period of time, the market is most often positive. So 67% of the time, you would say that 91 years that we're looking at here, 61 of those years, the market was positive, and 30 of those years, the market was negative. So 67% versus 33%. Right there, that is incredible odds of having a positive return in the market. This is really important to note, by the way. We're talking about a broadly diversified portfolio of, 500 stocks and owning a piece of all of those. There's a big difference between investing in a single company or investing in a diversified portfolio of company stocks. If we were looking at every single company individually, the data would not be this clean. Your chances of having, just horrible years, go up significantly. So this is kind of, I wasn't planning on really talking deeply about diversification, but as a sidebar, diversification, very important. Okay, so investing over 1 year periods of time. Okay, so I want to show another graph here. What we're looking at is an analysis of what would your return had been if you had invested starting over the last, going back 20 years, and what if we're going to look at two people. So one person invests on the very best day to invest every single year. So what we're looking at is this person invests when the market happened to be at its very lowest point for the year. Okay, because if you invest at a low point, right before it goes up, okay, that's great. You just get to participate in the upside while avoiding the downside. Now, on the flip side, we're going to look at that 20-year period of time for somebody who invested every single year at the market top for the year. So they invest, and then the next day their investments go down. And we're going to look at the total return for that person over the 20-year period of time to see what the results are. Here on the left, we're looking at somebody who invested on the very best day. So they invest on a market low, so back on, if you can look at these dates, we can, for fun, you get extra points if you go back and look at these dates to see how the market was performing. But these were market lows every single year starting in 2005 and going forward. Now here on the right, this person is investing on the very worst day. So they're investing on a market high for the year, and so they invest, and then subsequently their investment drops in value going forward. Okay, so let's run this forward and look at the total returns. Now, the person was able to invest at a market low for every single year. Their 20-year average return would have been, over this 20 period of time, 12.25% per year. Compare that. Okay, that sounds pretty great, right? That is great. We compare it with somebody who was unlucky enough to invest at a market top every single year and subsequently watch their money go down in value. Their average return per year over this period of time, compounding, would have been 10.5% per year, which is frankly incredible. And the reason I show this is because it really demonstrates that you can waste a lot of time trying to avoid market downturns and capture upturns, etc. But frankly, you're probably like a lot of other people where you have a job, you have a life, you're trying to live. You've got a spouse or a partner, you've got kids, you've got responsibilities, you've got hobbies and interests outside of watching, charts and screens and numbers, on a computer. And so you can spend a lot of time and energy trying to time and get your money in at just the right time and get it out at just the right time. Or you can set up a regular investment program where you simply just invest on a regular basis, like, when you get paid every month or every other week or something like that. And you just automatically, come hell or high water, rain or shine, you invest a little bit consistently over time. And inevitably with that approach, you're going to invest on some good days, right? Where happen to be market low and the market goes up, and inevitably you'll invest on some bad days. You invest and then the market tanks right after that. That's not really the point. The point is the principle of success here is the consistent investing, and instead of wasting your energy pursuing this perfect thing of always investing at the right time and avoiding downturns, spend more of your energy and mental and emotional energy and attention on other things in your life that are more important, and just set up a regular investment program. Looking at history again, that's shown to be a great approach. Okay. All right. The next principle we're going to talk about is diversification. So the time in the market, trying not to time the market, all of that analysis that we looked at, that was just based on looking at investing in the U.S. stock market. And I talked about diversification already from the perspective of investing in a basket of companies versus investing in just a handful or one or two companies. Now, there's kind of an expanded view of diversification, which is investing in different investment categories. So with the S&P 500, we're talking about large American companies. What about smaller or medium-sized American companies that are available to invest in, but they are not in the S&P 500. Now, what about companies that are based in other parts of the world, in other countries, or other types of investment instruments like investing in real estate, whether it's here, in the United States or internationally, or different kinds of real estate, commercial real estate, residential real estate, whatever. How about investing in different things like commodities, like investing in oil or gold or silver, or in cryptocurrencies like Bitcoin or Ethereum or something, or investing in simply companies based out of the United States? How about making loans, in the form of bonds, lending money to different corporations, locally and internationally? I'm I'm mentioning all these different investment categories to just kind of demonstrate there are so many ways that you can invest, so many types of assets as an investor that you can own. And the investments we see the most and we think of the most are things here locally. So we think about the S&P 500. It's what's talked about, most commonly, but there are so many other great investment categories that are available. At the end of the day, what's our objective as investors? Is it to just have this fun, interesting portfolio, so we have something interesting to say and try to impress people when we're at a family barbecue or something? No, I would say it's not. The purpose of investing is to accomplish something else, like getting ready to retire or to have a good retirement or save for something else that's very important, right? And so we talk about diversification because it is a strategy that helps us to reduce risk in our portfolio and stay invested. Okay, so on the screen, this chart is a little crazy, but basically each one of these little squares represents a different investment category. I call them asset classes, as the way they're referred to, different classifications of assets, right? So green, this is like the S&P 500. This orange are like smaller U.S. companies. This light blue is if you look, it says REITs, real estate investment trust. This is like investing in commercial real estate. There are different types of bonds and commodities, investing in cash, etc. Okay, so here we are, starting right here in 2010 and going along, and these different investment categories are ranked from best performing to worst performing for that given year. So if we kind of dial in, we look in 2010, you can see that the best performing investment for that year was real estate. And if we go down, we can see next best was small American stocks. Then EM equity, that stands for emerging markets. Think companies based out of China or the Philippines or Mexico or Brazil. Then we have investing in commodities. Here we are, S&P 500, large capitalization companies, right? High yield bonds, going down and down. Worst performing investment broad category was investing in cash, earning about 0.1% that year. So we go along and you can see in 2011, you can see stacked from top to bottom, what did best, what did worst. You can see as you go along from year to year, there are patterns. Admittedly, looking back at the past, you can see some patterns where, look, here we had from 2010 to 2015 where real estate did great. There was one year, 2013, where it was kind of down, but it was still a positive year. It only made 3%, right? You can see that probably the one that I would say the most consistent theme here has been since 2013, investing in large U.S. stocks. Basically, you've been at the top or near the top for many of those years. So 2013, 32, 13, 1.4, then 12, then 21. Then negative 4.4, then back up to 31%, then down to 18%, 28%. We had this one kind of negative year in 2022, down 18, then back up positive 26, positive 25. Okay, so I'm showing you this. First is just to make you aware that there are many other investment categories available to you apart from just investing in the S&P 500. There's lots of other great things to invest in. But our objective investing in other things is only to the extent that it has the potential of helping our portfolio do better and it helps reduce risk, i.e. when, let's face it, the main component of most portfolios is going to be investing in big U.S. companies. What we're looking for is, frankly, when that thing is down, are there other investments that are going to be up a little bit or maybe not down as much or whatever that can help us to provide opportunities to rebalance and buy some stocks while they're down, that sort of thing, to help manage risk over time. And so the whole point of this is to talk about diversification as a principle, very important to your long-term investment and retirement success. And there's a lot more. You can kind of broaden the horizon, think internationally, think about more than just what you hear about on kind of with the S&P 500. There's a lot of other things out there that are available to you. And now more than ever, really low cost, easy, non-complicated ways to get exposure to these types of investments right within your 401k plan or right within, through Schwab or through Fidelity or Vanguard, wherever it is that you have your investment accounts. A little bit of food for thought. Okay, now I promised that I would go over some of the things, some of those common characteristics that I see as an investment advisor that get people into trouble making investment decisions. And I will tell you that I see this all the time with people, and it's one of the most sad things that I experience personally is sitting with someone and learning about something horrible that happened to them financially. day, and the world's a rough place, and there's horrible things that happen. So a little bit of food for thought about things to look out for. Number one, probably pretty intuitive to most people. If you're thinking about making an investment, whether you're just researching it online or there's somebody sitting across from you who's trying to persuade you, convince you to buy something or sell or invest in something, please avoid high pressure situations, which is so tough because once you're in a high pressure situation, there's a lot of pressure to make to go along with whatever you're doing. That's the nature of high pressure situations. But almost certainly, almost always, basically always, high pressure situations, making a decision in that moment is going to be like the worst thing. Most of the time when someone makes a high pressure decision, they don't wake up the next morning and go, wow, I'm so glad I agreed to that. That was so great. I feel so confident and good about it. That's like never the case, right? You wake up with buyer's remorse, and so avoid high pressure situations. Specifically in the investment world, I see some recurring themes and tactics that are used. Number one is, the illusion of like, oh, it's a limited time offer. Like, oh, there's this investment thing that's, but there's only this short open window to be able to invest. And after that, you're never going to be able to do it again. And everyone who invests in it, they're going to be awesome and you're going to be outside and you're a loser because you missed out. Limited time offer. Don't miss out. Like, give me a break. Like, if that's the pitch that you're getting from someone or the way something is being presented to you, I'm sure someone's going to prove me wrong, but 99% of the time, just garbage. Don't even worry. Like, just, okay, well, all of a sudden, what you were saying sounded pretty good, but now I suddenly have a gross taste in my mouth. This is probably a bad idea. Avoid that thing. Another tactic that's used is selling the idea that something is very sophisticated. And this is something that only the very ultra wealthy have access to. But now you can have access to this super sophisticated, special, exclusive investing opportunity as a regular investor. In my experience, 9 out of 10 times, that idea is also total bupkis.
Bupkis.
It's crazy. I mean, using history as a way of looking at this stuff, most of the time, just investing in boring things like low-cost ETFs and mutual funds that anybody can buy. There's nothing sophisticated or exclusive about them. Investing it with that type of strategy would have been far better than using some super fancy, sophisticated, exclusive investment strategy that's only available to the supposedly ultra wealthy or institutions or whatever. So if that's the way something's being presented to you, the more complicated something is, usually there's more ways that it can go wrong. And so it's almost always it's not worth it. And the last kind of sales tactic that I see fairly common is this idea of, I'm going to teach you this special way of investing that Wall Street insiders don't want you to know about. And it's almost always like some type of insurance product, which just makes me laugh because there's nothing more Wall Street than like investing in some complicated like investment / insurance product that's like, has like a disclosure packet this thick full of, legalese to, stop you from suing the company once, the investment doesn't work out very well. But it's almost always presented by some guy going, this is what Wall Street doesn't want you to know about. So anyway, if that's the type of pitch you're getting, almost always just go the other way because it's probably not going to work out well. Here's my disclaimer for all of this. This is not investment advice. I'm talking about general investment principles. This is education based. Now that we've gone over these investment principles for success, as well as these things that you should avoid and look out for, you're in a better position to prepare for retirement, to be as ready as possible for when you decide to finally transition out of the workforce and go on to the next chapter of life. If you have more questions and things that, you would like help with personally, please reach out. I'm happy to talk with you one-on-one. Just click the link in the description below. Until next time, you have a great one.